The last couple of bull markets in gold, the mid-1970s to 1980, gold was in the fixed price in the 30s. It went to 850, 1980. And then from 2000 to 2011, 10, 11-year bull market went from $260 to $1,920. You had eightfold moves. We're nowhere near the metrics of the prior bull markets in terms of what is the multiple gain over the span of, let's say, a decade. We're nowhere near close. If we matched those, merely matched the geometrics of those moves, would be $8,000 gold. And so people, that's outlandish. Well, I mean, it's nothing. You're repeating history. And right now, we argue you've got more powerful, potent technical and fundamental technicals out there in these other major asset categories to help drive gold, meaning drive the central banks into panic, and therefore drive gold to the north in a big way, possibly even much bigger than an eightfold move.
The yellow metal has forged meteoric gains this year, emerging as the world's second best performing asset. Gold prices are expected to continue rising in 2024, with the prospect of reaching new highs in the second half of 2024 as central banks ease monetary policy and geopolitical tensions escalate. MichaelOliver is a leading technical analyst, renowned for innovating momentum structural analysis. In March, gold, silver, and mining stocks broke out above their annual momentum levels, leading to a significant rise in prices. If historical patterns hold, gold could experience extraordinary growth, reaching $8,000 per ounce. While reflecting on the market, Michael observes that recent momentum shifts have pushed bonds higher, while the dollar has dropped below key levels. Similarly, he points out that the bond market broke out of a quarterly momentum base to the upside, following gold's breakout in March. Yields on the benchmark 10-year Treasury note in August dropped below 4% for the first time since 2024's opening week. Yields were significantly lower than a 2024 peak of 4.70% in April, and nearly 5% reached in October 2023. Based on the Bloomberg U.S. Aggregate Bond Index, with yields declining, the bond market's total returns moved into modestly positive territory year-to-date in July. Meanwhile, as of the 29th of August, government bond markets, which have enjoyed a summer of solid price gains, now face a reckoning with their bets for speedy central bank rate cuts and slowing inflation, not to mention a tight U.S. presidential election. While supporting his current thesis, Michael predicts the final shift when the stock market's quarterly momentum floor breaks to the downside, completing the alignment of these four major asset categories. According to him, this shift will solidify a trend of going long on gold and T-bonds while taking short positions on stocks and the dollar. Now we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Gold and silver and the miners broke out above annual momentum basing actions as of March of this year. In other words, I had momentum structure overhead, like the floor I described on the S&P below that you're likely to break, momentum floor I'm talking about. Gold had a ceiling above it, and it broke through it, and that's when gold gushed above 2,000 and shot up now to 2,500. Silver went from, $20 to 32, it's now just below 30. That occurred then, but when I looked at the other major asset categories, like the bond market, US T-bond market, dollar index, the dollar index was holding a floor on its quarterly momentum that we defined as being broken at 104.40 about a month ago. This is cash dollar index. It's now down under 101. It's 100.50, I think. So it's dropped, not crashed. It's just oozed down fairly significantly. And I know if you break 100, you're going to have a lot of price chart technicians start to scratch their head and say, oh my gosh, this is topped out. We think it's topped out. So we've had the bond market was doing the opposite. The bond market, if we plotted our momentum oscillator, quarterly momentum again, where you plot monthly action in relation to a 3-quarter moving average, it was confined below a ceiling. In other words, a shallow ceiling, not a floor to break, but a ceiling to break out above. You broke out above that a month ago. T-bond futures then were just above 120. Right now we've been up to 126. We're trading 124, 125 area. So they broke out of a quarterly momentum base to the upside, lagged to the gold breakout that it registered in March. So again, we have two big asset categories that broke out upside based on our long-term momentum. And we thought the bonds should do that. Why? Not because the Fed's cutting rates. We're talking long into the debt market here. It's because asset managers begin to reallocate assets out of that which they perceive to be higher risk, less reward, into something lower risk, more reward. And that would be the T-bond market. Whereas a lot of them perceive the stock market to be less reward, higher risk potential. Now, they have to be long because they're competing with other asset managers. And if you're not long and it's going up, you lose customers. But there's a lot of suspicious asset managers out there who are ready to make that shift. And they've already begun to. You can see it both in the T-bond upside action. You can see it in the stall in the stock market. And you can see it in the gold surge that we've had since late March. So there's been some asset class shift out of those three categories. The dollar foreign exchange, major foreign exchange. Again, the dollar is inverse of primarily the euro and the yen. That comprises like 70% of it, of the dollar index. It has been dead as a doornail for almost 2 years, where after that collapse we had in 2022, we were up at $115 index. We collapsed down near 100. And since then, since early 2023, the dollar has more or less gone sideways in about a single percentage range. Up, down, but going nowhere. So it was a non-event. It was the quiet one, we called it. Watch out for the quiet one, sitting in the corner. It broke its quarterly momentum to the downside. Again, so another major asset category that where quarterly momentum is looked at as our trend assessment, it is now freshly broken to the downside. So again, gold upside, March. A couple of months later, bonds upside. And over the last month, dollar downside. The only one that's waiting is, again, what I described with the NASDAQ 100, the floor underneath quarterly momentum on the stock market. That's the last one to complete, and I think it will, meaning break to the downside. That means all those four major asset categories will have decided their new direction. In this case, we're talking long gold, long T-bonds, short stocks, short dollar. That's how we see the mix right now.
From a technical perspective, MichaelOliver notes that while day-to-day actions might suggest gold and the stock market are in sync, their monthly momentum charts are in total opposition. He expects that if the stock market declines and gold doesn't follow, it could surprise many and lead to a buying panic in gold. The price of gold and the S&P 500 have had their first solid halves of the year, and they're up roughly the same amount, 17 to 18%. However, looking back 20 years, for example, gold has outperformed the S&P 500. Precious metals' performance can be attributed to their unique position as real assets, which has one of the lowest correlations to stocks across asset classes. In reflection on moving towards safer assets, Michael mentions investors like Stanley Druckenmiller have successfully shifted from tech stocks to gold miners. He anticipates this shift will restore the 60-40 stock-bond portfolio mix, making bonds more attractive. Let's get back to the interview.
Monthly momentum, what we measure is against a 3-month moving average. Not just overlaid on a price chart. That's meaningless. That's noise. But we oscillate price in relationship to where's the 3-month average this month? Where is gold price in relation to that? Is it above it, below it? And if we plot it on our oscillator, if you go back a year and plot a monthly momentum of the S&P or NASDAQ, and go back a year and plot a monthly momentum bar chart of gold, they're in total opposite sync. The stock market is trying to top its monthly momentum. Gold has been pulling back since an April peak reading high. And we know we got the 2450 back in April. Now, price has gone marginally higher, but momentum has corrected downside. While price cooled off, momentum had a benign pullback. But the momentum readings dropped while the S&P readings were going up. Ever since almost a full year ago, you could put these charts on a page and you'll see they're total opposites. So yes, the day-to-day action sometimes tells you, oh, they're in sync. But when you look at monthly momentum, they're totally inverse, and we're more focused on that. So I think a lot of people are going to be fooled when the stock market rolls over and generates some fear that if gold doesn't go with it, you're going to have a lot of people fooled and therefore surprised. And what does surprise create? Sometimes panic. In this case, buying panic. In case of stocks, in case of the gold market. So anyway, so don't have that in your mind too much, the synchronization, because they're really out of sync. These events occur, you will see movement. And I think there's some wise asset managers who are not gold bugs, who Stanley Druckenmiller, for example, back in mid-February said he was going to dump a bunch of tech stocks. Well, if you look at the big key tech stocks he dumped, he pretty much hasn't missed anything. They dropped, they came back up, but basically he got out at a pretty good time. Okay. And at the same time, he bought Newmont Gold, biggest blue chip gold miner in the world. It produces more gold by 37% than the second biggest miner, which is Barrick Gold. Newmont then was trading around $31, $32. Right now it's trading at $52 6 months later. He's doing pretty good. And I think that was largely, I can't get into his mind, but I think it was probably a sense that, hey, higher risk, less reward, stock market, less risk, more reward, monetary metals. And especially a beaten up major gold miner like Newmont was. So Newmont's got up 60% in 6 months. Pretty good move. And in recently, we had these flinches in the gold mining sector over the last week or so, down 1% or 2 or 3, and Newmont doesn't even flinch. So you're right on the asset reallocation issue. And I think you've seen it in the T-bonds as well. They're now moving inverse to the stock market, which is something we expected to see happen, where I think you're getting that 60-40 portfolio mix, the orthodox thing, 60% stocks, 40% bonds. That was a disastrous concept in 2022. They both got smashed, huge. Bonds were down more than stocks that year. But this time the technicals justify that relationship back to normal, where bonds, long into the debt market, is a safe place to be relative to the stock market.
If historical trends repeat, gold could surge to unprecedented levels, with the potential for significant gains in the coming years. CoinPrice Forecast predicts that the price of the precious metal will continue to rise from 2027 to 2030, reaching $4,649 per ounce. Given the current market dynamics, do you think gold and bonds will continue to outperform? And how are you adjusting your investment strategy in response to these shifts? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.